In the early 1970s, something quiet happened that would reshape everyday life for millions of people. There were no tanks on the streets, no public panic, no emergency speeches. Just a policy decision that changed how money worked forever. From that moment on, prices slowly began to behave differently. Savings felt less reliable, work felt less rewarding, and power started moving in ways most people couldn't see. Today, inflation is treated like bad weather. It is something people complain about but accept as unavoidable. News anchors explain it with charts. Politicians blame it on crises. Corporations blame it on costs, but inflation is not random. It is not mysterious, and it is not neutral. Inflation has direction. It always moves power from some people to others. To understand inflation, it helps to stop thinking about money as paper or numbers on a screen. Money is access, it is time, it is security. It decides who can wait and who cannot. When inflation rises, that access is redistributed, but it is never shared equally. Throughout history, inflation has appeared during moments of stress. Empires used it to fund wars. Governments used it to manage debt. Leaders used it to delay collapse. Ancient Rome reduced the silver in its coins. The coins looked the same, but they bought less. Prices rose. People blamed merchants. The state survived longer than it should have. Inflation did not save Rome, but it bought time for those in charge. The same pattern appeared again and again. In revolutionary France, paper money lost value while insiders protected their wealth. In post-war Germany, inflation destroyed savings and social trust before it destroyed the currency itself. In every case, inflation followed pressure, and in every case, the damage was uneven. Modern inflation works the same way, just with better language and cleaner systems. Imagine the economy as a long road. New money enters at one end. Prices rise at the other. The people closest to where money enters feel the benefits first. The people farthest away feel the pain last. By the time inflation reaches them, prices have already changed. When new money is created, it does not appear in everyone's wallet at the same time. It enters through specific channels: government spending, financial markets, large banks, major corporations. These groups spend the money while prices are still lower. They buy assets, they refinance debt, they expand. Later, the money reaches workers, consumers, and retirees. By then, housing costs more, food costs more, services cost more. The money is weaker when it arrives. This is not an accident, it is how the system works. People who earn wages feel inflation differently from people who own assets. Wages respond slowly, prices respond fast. Even when wages rise, they usually follow inflation, not lead it. This creates a permanent gap. Workers feel like they are running less to stay in place. Asset owners experience the opposite. Stocks rise, real estate rises, scarce assets rise. On paper, this looks like growth. But often it is not growth, it is repricing. The measuring stick is shrinking. Inflation does not reward effort equally, it rewards position. Those who already have access to capital feel protected. Those who depend on fixed income feel exposed. Savings lose value. Debt becomes easier to manage. Borrowers benefit, savers lose. Governments understand this very well. Inflation solves a political problem that taxes cannot. Raising taxes creates anger. Cutting spending creates resistance. Inflation creates neither, at least not immediately. It spreads the cost quietly. It reduces the real value of debt. It shifts blame. It buys time. Inflation is the only tax that does not need approval. That is why it is tolerated. Large corporations also understand inflation. They prepare for it. They raise prices faster than wages rise. They lock in cheap debt. They buy competitors who cannot survive rising costs. Inflation reduces competition. It favors scale. It rewards size. Small businesses struggle. New companies fail. Markets consolidate. Inflation does not just change prices. It reshapes markets. Over time, something deeper changes. Behavior. When people believe money will lose value, they stop saving. They spend faster. They speculate. Long-term planning feels risky. Short-term thinking becomes normal. Trust weakens. Inflation turns patience into a disadvantage. This is how inflation becomes social, not just economic. Every inflation cycle follows a familiar path. A crisis appears. Money is created to prevent collapse. Collapse is delayed. Power concentrates. Inequality grows. Trust erodes. Then the system adjusts, resets, or hardens. In the modern world, inflation has become normal. Central banks talk about managing expectations. Governments talk about resilience. Corporations talk about margins. People lower their standards quietly. This is not failure. It is function. Inflation moves power away from people who depend on money staying stable and toward people who can move faster than prices. It decides who waits and who advances, who sells assets under pressure and who buys them cheaply. Inflation is not chaos, it is selection. Those closest to money creation adapt. Those farthest away absorb the cost. This does not mean inflation is always planned in detail, but it is tolerated because of who it benefits. It protects debtors, it protects institutions, it protects systems under strain, and it leaves individuals to adjust on their own. The most important thing about inflation is not how high prices go, it is who gets there first. Inflation is never just about economics, it is about power. It decides whose mistakes are forgiven and whose are punished, whose wealth grows quietly and whose disappears slowly. The system does not announce this transfer, it does not explain it clearly, it does not ask for permission, it simply happens. Understanding inflation does not stop it, but it changes how it is seen. Inflation is not bad luck, it is not natural disaster. It is a mechanism that moves value from one group to another. Once that is understood, inflation stops looking random, it starts looking deliberate. And the only real question left is not whether inflation will continue, but this: when prices rise again, who will gain the power they lose?